Equities have just logged their strongest weekly rally since April, powered by AI earnings and robust nominal growth, even as long-dated yields and this week's inflation data keep macro risks squarely on the table. Welcome to vTalkInsight, Equity Pulse Daily for August 11th, 2026. U.S. equities have just delivered their strongest weekly advance since April, with both the S&P 500 and the Nasdaq gaining more than 5% and signaling a clear risk-on tone. That optimism sits uncomfortably alongside long-term U.S. yields above 5.2% and a bond market increasingly focused on persistent inflation, heavy fiscal deficits, and large issuance needs. The immediate focal point is this week's U.S. inflation data, with consumer and producer price reports expected to be the main catalysts for near-term direction. Market odds of a September rate hike have already slipped from around 60% to roughly 40%, but Fed communication keeps stressing that any upside surprise on prices could quickly put hikes back on the table. Recent data provide ammunition for the dovish camp. Core inflation has cooled for 2 consecutive months. Headline and core CPI have recently printed at or below zero on a monthly basis, and economists now expect only a 0.1% uptick in headline CPI, while payroll revisions and slower wage growth point to a labor market that is losing some steam. Set against that, core CPI, headline CPI, and core PCE all remain above 3% year-on-year, and policymakers continue to highlight stubborn pressures from energy, AI-related investment, and tariffs. With inflation having run above target for most of the last 5 years, the risk is that expectations become more entrenched, which explains why front-end yields remain elevated and investors are inclined to sell into Treasury rallies until the trend in prices is unmistakable. For equities, the macro mix still leans toward a soft landing scenario. Nominal GDP is running between roughly 6 and almost 8% depending on the inflation measure used, supporting powerful earnings growth. But that same strength argues for interest rates staying higher for longer, limiting the scope for a big rally in long-dated bonds and challenging traditional 60-40 portfolios, even as the equity side benefits from strong top-line growth. Under the surface of the rally, the earnings picture is unusually strong for a mid-cycle environment. S&P 500 profits are estimated to be up around 50% year-on-year, and even stripping out one-offs, growth of about 30% leaves valuations roughly 12% cheaper on a multiple basis than at the start of the year despite the index making new highs. The AI and tech investment theme now touches more than half of the S&P 500, spilling over into markets like Taiwan and Korea that supply critical chips and equipment. Investors are becoming more selective, distinguishing between companies merely exposed to AI and those able to translate AI adoption into durable margin expansion and free cash flow generation. Compared with earlier in the month, market breadth has clearly improved, with financials, healthcare, and industrials contributing more to index gains and small caps increasingly trading on bottom-up earnings rather than macro headlines. Even so, market cap-weighted indices continue to beat equal weight and small cap benchmarks, underscoring how a handful of very large names still dominate performance and mask the sizable drawdowns many individual S&P stocks have suffered this year. Outside the U.S., European equities have been surprisingly resilient given higher local energy costs and yields, with roughly 3/4 of stocks' 600 constituents trading above their 200-day moving averages. Analysts now expect earnings growth of roughly 10 to 15% annually across the S&P 500, small caps, and developed markets through 2027, which helps explain why JP Morgan felt confident enough to lift its S&P 500 year-end target to 8,000 based on a projected 35% EPS surge. Positioning and flows reinforce the risk-seeking backdrop. Active ETFs account for about 86% of new launches. Active fixed income funds are drawing close to 40% of bond ETF flows. Thematic products have grown to around $60 billion, and leveraged ETFs, particularly 3 times semiconductor vehicles, now represent roughly $200 billion of assets and 13% of ETF trading volume, highlighting both confidence in dip buying and the potential for sharper swings if the cycle turns. The biggest swing factor for the inflation outlook now sits in the energy complex. Shipping through the Strait of Hormuz remains severely constrained, with only about 5 vessels transiting per day compared with a normal pace of 14, as stalled negotiations between Iran and Oman and a harder line in Tehran keep any reopening limited and temporary. Brent crude has oscillated in a broad $70 to $100 range since July and is currently trading in mid-80s, but it is refined products where the real stress shows up. Diesel crack spreads have surged to around $80 to $85 a barrel, reflecting tight global capacity after Russian refinery strikes, supply losses from Qatar, and constrained Chinese exports, with product prices in some cases trading at parity with crude benchmarks. Europe faces a particularly acute challenge, with natural gas prices around $20 per MMBtu, river levels crimping hydro and nuclear output, and gas storage unlikely to reach comfortable levels ahead of winter. Elevated diesel and gas prices are expected to exert meaningful upward pressure on consumer prices on both sides of the Atlantic, especially given diesel's outsized role in U.S. transportation and in the CPI basket. These energy dynamics sit uneasily alongside recent benign headline inflation prints. While some analysts argue that so far the pass-through has been limited, policymakers also flag energy as one of the few areas where further rate hikes would do little, leaving them with a narrower set of tools if an energy shock were to reignite broader price pressures. For equities, that mix is supporting renewed interest in energy producers and infrastructure, with sector ETFs showing some of the strongest trading volumes among major groups. Companies such as ADNOC Gas are committing billions of dollars to expand output, while the Pentagon's push for higher weapons production underscores upside for defense names if geopolitical tensions around the Middle East persist. The AI infrastructure build-out remains the central growth engine for global equities. Major technology firms are expected to push combined capital expenditures above $1 trillion next year, as demand for data centers, power generation, and advanced cooling surges, while cloud revenues for platforms like Google, Microsoft, and Amazon have been growing at roughly 40 to 70% year-on-year. On the hardware side, Taiwan's semiconductor manufacturing company is emblematic of this momentum, reporting a 45% year-on-year jump in monthly sales to about $14.5 billion and raising its full-year revenue growth guidance to more than 40%. TSMC has also lifted its 2026 growth target above 40% and plans $60 to $64 billion of capital spending across Taiwan and the U.S., underpinning strong sentiment in European semiconductor equipment names such as ASML, Infineon, and STMicroelectronics. Financing this build-out is increasingly complex. Roughly a third of data center projects are being funded by banks, another third via public debt markets, and about a quarter through private credit, with NVIDIA teaming up with private credit giants like Apollo and Blackstone to mobilize around $100 billion of capital for AI compute infrastructure. Equity market reactions highlight where investors are drawing lines. Intel's decision to raise $15 to $17.25 billion of stock to fund roughly $20 billion of AI-focused capex, after its share price had tripled year-to-date and data center revenues grew 59%, still triggered a 3 to 5% drop in the stock as dilution and negative near-term free cash flow came into focus. Apple faces its own cross-currents, with an expected shift in the iPhone upgrade cycle and price increases of around 15%, offset by a larger subscription base and a projected on-device AI upgrade wave around 2027, even as a downgrade from Jefferies on pricing power and production risks weighed on the shares. Meta, by contrast, saw a positive reaction after launching a 30 billion parameter AI model designed for consumer hardware and doubling down on an open-source strategy, while Google's leadership shakeups, talent departures, and recent AI security incidents have encouraged some rotation from the stock into semiconductors. Stepping back, the equity story is being pulled between extraordinary earnings power, led by AI infrastructure and robust nominal growth, and a macro backdrop still defined by elevated long-term yields, ambiguous Fed reaction functions, and a highly unstable energy complex. Within that tension, leadership is gradually broadening beyond a handful of mega-cap names, but concentration risk, Funding strains for capital-hungry AI projects and rising regulatory and geopolitical pressures remain key fault lines to monitor. Over the coming weeks, how incoming inflation data interact with energy prices, long bond yields, and AI-related capex plans will be critical in determining whether the latest 5% plus rally can be sustained, rotated, or partially unwound. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.